Hi, good morning. We'll start today's webinar. Today is 9th July. Today we will give three industrial updates regarding coal sector, offshore and marine sector, as well as property sector. So, and after that, we will give updates on our Phillip monthly recession checkers. Okay, firstly, we'll take a look at Singapore Coal monthly. So what happened over the past 1 month was that China's reported surge in seaborne coal imports. So as you can see here, in the first half of this year, China's seaborne coal imports increased by 14%, arriving at 127 million tons. So out of the four main countries, Indonesia became the biggest source of coal supply by delivering 62 million tons of coal, and year-on-year increase by about 34%. Also in June, China relaxed the coal import restrictions. The rationale behind this was because the authority need to prioritize the coal supply for power plants, as we knew that the summer season has come, and because of this, the demand for thermal power started to pick up. So the authority must ensure the power supply, especially the thermal power. And also in 3rd July, central government announced the anti-pollution plans to curtail coal. So actually this plan is nothing new, just reiterate the cut down of coal consumption for the next 3 years time. So what is our view? We think that the demand for coal is still strong in China. As you can see here, China's domestic production continue to remain flat. However, the demand for power, especially the thermal power, remains to be strong. That's why China needs to import more thermal coal from overseas market. So in June, the total port coal inventory jumped about 50% year-on-year. That's why we think that the security of coal supply in the near term became the authorities' priority over any clampdown of coal prices. So for Indonesia coal market, the HBA, the coal price reference, hit a 6-year high in July, arriving at more than $104 per ton. And also, the domestic miners produced a total of 145 million tons for the first 5 months this year. And the MEMR, the authority set the annual domestic production target of 485 million tons. So year-on-year up 5.2%. So these are the charts we keep checking on both two coal markets. So firstly, you can see here, as of May, the domestic production growth maintained at 0%. And that's why since the thermal power demand resumed back more to 10%, and also the hydropower demand increased by around 5% year-on-year. That's why they need to import more coal from overseas market. So you can see here the HBA price touched the 6-year new high. So there is no doubt the China port coal prices rebounded back to the abnormal zone. So you can see here the port coal inventory jumped phenomenally to more than to close to 50% as of June. So next, we'll talk about the offshore marine monthly update. So firstly, as we knew that the oil prices are rallied since third quarter last year, and in June, the Brent price hit a more than 3 years high of US $80 per barrel. And since last year, the oil market turned from contango to backwardation. That means the current oil supply level is lower than expected. And the US EIA, the Energy Information Administration, forecasted the supply demand dynamic will resume at a relatively balanced level in the next 3 quarters. So if you pay attention to the recent oil market news, we knew that US has been putting sanctions on Iran's oil export, and also they urge Saudi Arabia to increase the daily supply by 2 million barrels. However, we knew that according to Bloomberg, the OPEC spare capacity was below 3 million barrels per day as of May 18. That means there is little room for OPEC to increase the output. As they mentioned, the 2 million barrels per day capacity is quite expensive for them to use based on current oil price level. And also we see that the US production, though they have been increasing over the past years, they started to encounter some bottlenecks such as the pipeline capacity, obsolete infrastructure, and lack of workforce. And the next is about the offshore drilling activities. We see the sign of recovery, but the day rates are still soft. We do see the average utilization rate of offshore facilities climb back to more than 60% as of June. However, the day rates of these jackup rigs, semi-subs, are still on the downtrend. And also, it is worth noting that the oil majors started to turn around since last year, and especially for the first Q results, they make a significant improvement of their performances. However, for these oil majors, they expected the expected capex is just slightly higher than what they spent in 2016. That shows they are still quite cautious and prudent on the oil market outlook. So in the near term, we think that the oil market will continue to be volatile, since the market will continue to price in the geopolitical risks such as the trade war tensions and output disputes between OPEC and US, and also the recovery of global economy could slow down. So all these charts shows the current oil markets situation. You can see the Brent and WTI continue to rise. This is the EIA forecasted forecast for the next 3 quarters. You can see here the supply will be slightly more than the demand moving forward. And right now, the oil market is still under the situation of backwardation, and also the US crude oil stockpile started to decline since May. And you can see here the OPEC spare capacity actually is on the downtrend. So as of May, the spare capacity was close to 3 million barrels per day. So here shows U.S. crude oil production. So it has been increasing since July 16, but in June, the recent month, we can see a little bit flat here. So here, these two charts shows the improvement of the utilization rate of the jackup rigs as well as other offshore facilities. However, the day rates, the charter rates are still downtrending. So here, the first Q results of the oil majors like Shell, Chevron, BP, all these. Actually, the first Q EBIT was much higher than expected. We can see this is a sign of recovery. So here is the expected capex from these oil majors for this year. It's just slightly higher than what they spent in 2016. So that means the oil market outlook is still quite they are quite cautious on the oil market outlook. So next, I'll pass on to Don to talk about property sector.
Hi, thanks Guang Zhi. Morning everyone, De Hong here. I will give some updates on what you guys must have heard about last Friday on the cooling measures that came out from the government for the property sector. So on Thursday night, you saw that there were, I think, two sets of measures which were more binding. First one is the ABSD increase from, okay, it's a range, and I think the only people not affected will be the Singaporeans buying first properties. This one has remained at 0%, but for everybody else, regardless whether Singaporean buying second property, your PRs buying first property is not affected as well. So anyone else, Singaporeans buying second property, PRs, your foreigners, they're all subject to an increase of 5% for the ABSD. And for entities like developers, they are also subject to an increase in ABSD. This is from 15% to 25%. But note that this is the remissible, or in other words, this 25% is remissible upon the full sale of all your units within 5 years. And there's this additional 5% that is non-remissible, and this will be the actual impact on developers in terms of land acquisition costs, in terms of the direct hit on the margins. This 5% will be the direct hit to the margins. And another measure that came out was the lowering of the LTV limit. So right now, before this measure, down payment that everyone has to pay is 80%. With this measure now, it's changed to is increased. Your down payment will have to be 25% if you're a first home buyer. But of course, if you're second and third onwards, then the down payment is also increased. So it used to be 50% for your second home. Now you have to pay 55%, which means you can only loan 45%. So what do we think of all these cooling measures? I think first of all, like everybody else, we are caught by surprise. We were initially expecting and foreseeing that prices could still go up by a good 20% before there would be any unease on the government's front. And how we came up with this number is that if we look at how affordable prices have been in Singapore over the last decade, this affordability metric is something we use by taking the median home prices over median household incomes. If you look at that metric, we are not near the levels that we have seen. The peak levels over the last decade has been in 2010 and 2013. We are not near those levels. We could potentially still grow by 20% before we hit those levels. And why we thought that 2010 and 13 were important years was because 2010 was when the government started to come out with a series of cooling measures. And 2013 was the year when they actually came out with what I would say is one of the more stringent measures, because right after the TDSR measure in 2013, that was when you saw the transaction volumes really start to dip. So thereafter, from 2013 to 17, that was when we had the full 3 to 4 years of a down cycle, a gradual down cycle. So that's why in 2013 was when we thought that the measures dished out was one of the more stringent ones. In fact, later I'll show you a chart that actually correlates the transaction volumes and together with the timing of the dishing out of all the cooling measures and the impact they had on transaction volumes. So the next point is that no doubt that there will be a knee-jerk reaction, as you have seen on Friday, to developers' shares already. A lot of major developers with major exposure to Singapore property has been hit as high as 16% for CDL and Oxley. And likewise for physical transactions, I think it will similarly take a negative hit in the short term, a knee-jerk reaction as buyers now evaluate their options, the new taxes that they have to pay, the increased liquidity, the extra 5% in down payment that you have to pay. So I think in the short term, transaction volumes, you can see that they will be negatively impacted. And the next thing is that the en bloc frenzy, we expect it to slow because now for every new en bloc transaction closed, there will be an extra 5% tax on developers. So that will directly eat into their margins. So at current asking prices for the homeowners, en bloc owners, I think it will take longer and a higher barrier for developers to bite. And so now, if you look at now the crucial thing is developers who have bought land earlier at lower prices, they used to have the greater flexibility to adjust prices. But now this flexibility to adjust prices will be even more crucial because buyers become more price sensitive. If you have bought your land cheaper than your competitor, at least you can still lower your prices by 5% to offset the ABSD. And amongst the developers under our coverage, I think if you look at the land plots or the en blocs that have taken place this year or late last year, the ones that are later into the game, amongst our coverage, I think you will have Capital Land's Pearl Bank that was in February this year. And then some plots for CDL as well. You have Amber Park, West Coast Vale, your Handy Roadside, and the EC in Sumang Walk. Those are all at later stages. And but the CDL, the Capital Land edition, the Pearl Bank was acquired for about 700 million. Right now, they have total balance sheet assets of about 61 billion. So I think the exposure to local resi for Capland is very minor, because before this Pearl Bank, most of their existing inventory has been almost fully sold out. So that leaves them with only Pearl Bank as the only major exposure to the local resi. So with that being said, we have maintained our target price for Capital Land because this redevelopment surpluses for Pearl Bank has not been factored into our TP yet because of the later dated launches and because of the higher uncertainties involved. And likewise for CDL, the later launches for Amber Park, West Coast Vale, Handy Road, Sumang Walk have not been factored in as well. We have factored in the nearer term launches that has included the Tapestry, for example, South Beach, for example. Those ASPs that we have assumed for this, we will maintain them as of now. Tapestry, we will maintain them at 1,350. That has been the selling price on average since the launch. South Beach, we will maintain at 4,000 for now. And but because of the exposure to local resi for CityDev, they have as a percentage of the total RNAV for our estimates, the local resi take up about 35%. So because of this heavy exposure, and 35% is amongst our coverage, the highest exposure to local resi, followed by Chipping Sing. So in view of that, we have increased our discount to our NAV. It used to be 15%, now we've increased it to 20%. So right now, our entire suite of discounts in-house for the developers will range from 20% for the large caps and to 40% for the smaller caps, like Chipping Sing. So Chipping Sing is a 40% discount to our NAV. And for Chipping Sing, the adjustments that we have will be for Park Colonial. Our previous assumed selling prices were 1,900, and we will revise them down now to 1,750. That has been the average selling price you saw last Friday when they launched the project. So that Park Colonial is about 800 units. They have sold 300 plus units, about 40% last Friday. And in terms of Chipping Sing's the other development in Changi Garden, that one we have not factored in the redevelopment surplus because of the later dated launch that is expected. And the last one for Hobie is that the only exposure they have is in terms of the local residential market, that is in the 3 Sentosa condominiums that they have. We have assumed target prices, selling prices of about 1,005, and we will remain at these levels due to the already conservative nature of these assumptions that we have. So all in all, I think you will see that we have cut our target price for CDL because of the increase in discount to our NAV. So our target price has dropped from 1,340 to 1,260, but we are still maintaining our core accumulate. Chipping Sing, likewise, we have dropped our target price to 115, but we're maintaining a buy on it. And right now, we still maintain our overweight on the sector. We are remaining positive because of a few factors. First of all, the affordability ratios that we talked about. Then this is nowhere near the peak levels that we have seen, despite the fact that we have had the past 4 quarters of price increases, and because also of the fact that from 2010, since we recovered from GFC, you see that income growth has actually outpaced the home price increases. In terms of supply, we are still near one of the lowest levels in the last decade. We have an outstanding supply in the pipeline of 52,000. Look at the high 4 years ago, that was in 2013, that was about 96,000. And we expect demand to be still supported by the strong household formation rates due to our demographic structure, and as well as the en bloc liquidity from displaced owners. Okay, and by the way, I previously talked about ASPs. These are actually assumed selling prices. So I think we will next touch on or take a look at the impact on the previous cooling measures on the transaction volumes, because as you all know, this ABSD and this LTV reduction, these are not the first time we have seen them. In fact, if we okay, I'll jump back to this slide later, but let's look at historically what are the cooling measures that have come out and the timeline for these cooling measures. If you look at the first series of cooling measures that came out after we started seeing a strong rebound in property prices after the GFC. So in 2010, there was this LTV LTV cooling measure that came out. So prior to February 2010, if all of you can recall, if you were to buy a house, you only need to pay a down payment of 10%, right? But after Feb 10, 2010, that down payment has been increased from 10% to 20% because your LTV or loans, you can only take up to 80%. So that's the first time we saw the LTV reduction. 2011, then you have the first ABSD coming in. that round of ABSD was more punitive towards foreigners. Foreigners saw the ABSD of 10%. If you're a Singaporean, your first, second property, you're still actually pretty much immune. So thereafter, in 2013, then there was another round of adjustments to the ABSD. This time round is hitting Singaporeans and PRs more, because for PRs, back then in 2013, after 2013 January, if you're a PR, you're buying your first property, you're already slapped with a 5%. Before that, your first property is still a clean or zero ABSD charge. And for Singaporeans as well, after 2013, after your second property, you are already hit with a 7% ABSD. So all in all, these are not new measures to us. ABSD has been in the market for the last 8 years, LTV as well. If you look at the previous rounds of cooling measures, the blue line is actually the total monthly transacted volumes for private properties. These include the primary transactions, which will be the sales direct from developers, and the secondary transactions, which are the resale transactions. So Feb 10, like I showed you in the chart earlier on, LTV was reduced from 90% to 80%. So in other words, you have to put in a 20% down payment after 2010 Feb. Before that, you only have to put in a 10%, right? So after that, you can see that transaction volumes moved up even after a few months after the implementation. It was up and down according to, I think some of the causes for this up and down could be the number of launches in the particular month. But you can see that on average, it has not deterred, or it has not put a huge dampener to transaction volumes, this LTV reduction. Then we look at the first time ABSD was introduced, that was in 2011. 2011 December, we saw from this table, right? 2011 December. That was when I mentioned this set of rules are more punitive to foreigners because they are already slapped with a 10% ABSD, even for their first property here. So after this measure, what happened, right? So you see that knee-jerk reaction in the months after. Knee-jerk reaction, but thereafter, in the next following 1 year, you can see that actually from 2012 on, the whole year of 2012 to January 2013, in fact, the transaction volumes have not dipped much below the point in time where the first ABSD was introduced. Then 2013, the heavier ABSD, we recall this set 2013 Jan was when the ABSD was increased for foreigners. It's become from 10 to 15. PR, you buy your first property, you hit with 5%. Singaporeans, second property, you hit with 7%. After this, what happened? After this, knee-jerk again. And then after that, after the knee-jerk reaction, we went back to the same level of transactions we saw before the ABSD was introduced. But I think the killing point really came in June 2013 when the TDSR was introduced. Then that was the implementation of the 60% rule of your gross monthly income that is allowable for repayment of mortgages, right? After that one was really when we saw transaction volumes came all the way down. So I think you can see from the previous round that this set of cooling measures actually had a limited impact on transaction volumes. And it was only until June 13 then we start to see that transaction volumes really start to taper off. Now, I think why this is so, I think this is backed by the fact that if you look at the affordability ratios, this is using the median home prices over the median household incomes. And right now, I'm using this median home price that's about $1,000 per square foot. That's for outside central regions, in other words, your suburban regions. Using that number, these are official statistics, that number times a unit size for the average household, the average home price, divided by the annual income. Annual income will be derived by 12 times the median monthly household income, and currently that median number is about 9,000 Sing. So using that metric, you see that the median home price to income ratio as I mentioned, the peaks were in 2010 and 13. That ratio was about 17 plus in those 2 years. And right now we are doing about 14 plus. And also the fact is that these are, in calculating the ratio on the red line, I've used a median home price times the average home size. And in that average home size in this red line metric, I've used a size of 160 square meters. That's about 1,007 square feet. Okay, that, and why that number was used is because when I started the metric in 10 years ago, that was the average size of all the condominiums sold in those years. So I kept the size the same, use the median home prices times that size to get this red line. But now, as you all know, unit sizes are shrinking, right? When you look at 1,600 square feet home, that is easily one of the bigger units or biggest units in any project nowadays in a suburban project. Right, so because now if you look at the average sizes, I think they would range more between 1,000 square feet, thereabouts. So if you factor in this fact that the unit sizes are shrinking, you take the median home price times the new unit sizes, and you divide them by household income, then in fact you get a ratio that is even better, that is saying that versus 10 years ago, the affordability, in fact, you are looking at a much better ratio as of now. So as to like what the MAS chief has been saying about the home price increases in line with fundamentals, I think if you look at the period of time maybe in the last 2 years, then you see that this ratio has actually gone up quite a fair bit in the last 3 years because of the increase in the home price, especially from 3Q last year onwards. But in the longer term, I think if you look at the ratio, I think it's still pretty manageable. Okay, I will next pass on to Jeremy for the recession tracker.
Hi, good morning, everyone. Jeremy speaking here. So for my part, I'll just quickly run through what the US sort of thing is doing. Basically going through the monthly recession tracker for the updates in June. And all in, we are seeing definitely still risk-on kind of approach signaling out from the recession tracker. And just dive straight into this. So here's the update for the month of June, basically what the recession tracker is showing. So just focusing our attention on this particular column over here, you can see we are seeing more greens than red, telling us that on a month-to-month perspective, we are seeing further improvement both from the market-based data as well as the economic-based data. And all in, at least economically, we are seeing a lot of the economical data over here. They are signaling that they are still at their multi-year extremes. For example, consumer confidence from 3 of the surveyors, Conference Board, University of Michigan, and Bloomberg. We are seeing strong growth within the optimism side of things from consumer, as well as the manufacturing side of things, whereby purchasing managers are still signaling further optimism from their side. So all in, despite the trade war tension that we have been seeing for the past 2 months, optimism are still kind of roaring, at least from the sentiment side of things. And even hard data, retail sales number has been going pretty strongly, which I'll go through later in the following slides. But things to note in terms of weakness-wise, probably 2 indicators stood out, the unemployment rate as well as the 210 spread. So I'll just probably go through what the unemployment rate has been showing. So last Friday, we got the labor data. So labor data, headline number was pretty good. Non-farm payroll, we added 230,000 jobs in the month of June. However, the unemployment rate number kind of disappointed the market. So instead of continuing to improve off the prior month of 3.8%, we actually saw a deterioration from 3.8% to 4% in the month of June. And all in, we might be seeing the start of a reversal here since we are in a late stage economic cycle. For this to kind of confirm to us that we are seeing a reversal in unemployment rate side of things, I think we still need to see at least 2 to 3 more months, at least consecutive months of further deterioration within the unemployment rate for us to kind of call for a bottom in the unemployment rate side of things. And right now, the key threshold to watch for the unemployment rate is the 12-month moving average, and it's currently standing at 4.1%. So it's not really far cry away from the current 4% mark. So we'll be watching the unemployment rate number pretty closely in the due course in the following month. whether we see further weakness within the unemployment rate side of things or a further improvement again. However, looking at the unemployment claim side of things, you can see unemployment claims are still pretty strong at its multi-year low, and on a year-on-year perspective, we are still seeing pretty strong growth. Further improvement in unemployment rate year-on-year perspective, down 8% from the prior month of 1.3%. So all in, I think we need to see both sides confirming the weakness first before we could call for major weakness. And all in, like I mentioned, as a whole, the recession tracker is still confirming to us that it's signaling further risk on kind of approach for the general equity market, at least for the next 6 months out. And the only thing worth mentioning is the 210 spread here, which I'll go through in the following slides with chart and why it's right now kind of signaling some distress. So all in right now, in the near term, we still remain bullish on the general equity market as the recession tracker still remain pretty firmly within its threshold. So I'll just run through 3 main things that happened in the month of June, at least in the US. So number one will be trade tension that's been rising between US and China again recently for the past 3 to 4 weeks. Second part will be the Fed hiking its interest rate. And the last part will be the recent dollar strength causing some pain in the emerging market. So for the first part, trade tension, just to highlight our thoughts on the trade tension and the implication on the general equity market. As you can see over here, I've marked up 2 red zones over here. And the first red zone was actually the point where we first kind of get into this scare, the general sell-off sentiment the market faced when we saw a lot of threats being thrown back and forth between US and China in terms of imposing tariff. So in the month of March was when we saw that major sell-off happening within the market due to the trade tension. And at the height of the trade tension, this particular point over here on 2nd April was when we kind of got the confirmation that China has decided to retaliate with 25% tariff on 128 US goods. And that particular news actually sparked a major sell-off in the equity market initially. So on 2nd April, the futures market actually fell at as much as 3% on the day itself. But what we saw was that since then, the particular sell-off has more or less confirmed its market bottom here and anchored in a pretty strong solid base. And since hitting that particular low, what we can say is that probably that was the extreme of the trade tension between US and China. As you can see, since then, after the 3% sell-off, the market overreacted, and since then it have rebounded pretty firmly, up 9%. And right now, obviously, that particular low on 2nd April is more or less right now at a base here that we think the market should continue to hold up. And just to point our attention to the most recent sell-off here, this particular red highlighted area. So again, this area over here has been mainly caused by the trade tension scare again between US and China, throwing back and forth about imposing further tariffs of 50 billion on US and Chinese goods back and forth. And as you can see, the impact on the equity market has been pretty muted as compared to the first one that we saw in March. So all in, what we can say is that the market is actually digesting the trade tension news to treat them as less severe as what we initially faced. So the most recent sell-off you can see is almost only half the impact that we saw in this particular area. And all in, the message that I want to put across here with the chart is that all this trade tension scare, the negative sell-off sentiment usually wouldn't have a lasting impact on the equity market. And we expect this sell-off to remain short-lived, like what we saw in 2nd April, whereby we see a rebound back into the uptrend pretty firmly. So this recent sell-off, we expect it to remain short-lived. And at least on a recession tracker perspective, on a longer-term outlook, we expect this particular uptrend to kind of kick back in place. And in the due course for this sell-off sentiment to kind of fade away. The second piece of news that happened in June that is worth mentioning is the Federal Reserve hiking its interest rate. So the Fed hiked its interest rate again in June, lifting the Fed funds rate up from 1.75% to 2%. So what we see here is this most recent rate hike cycle began in December of 2015, where the Fed took its interest rate up from 0.25% to the current level of 2%. And just to highlight, in terms of the implication-wise for the most recent rate hike cycle, all you can see, just to run through what the chart is showing, the orange line is the Fed funds rate, the blue line is the S&P 500 index, and the vertical strips over there are the recessionary period. So historically, what we see is there is a strong positive correlation between the Fed funds rate to the S&P 500 index. And in other words, what it means is that as long as the Fed continues to hike its interest rate, we should see continued growth within the S&P 500 index. And in terms of how the signaling of the bearish market begins is when the Fed actually goes in a period of rate hike cycle into a period of inaction, keeping interest rate flat at a certain level, and the point when they actually suddenly cut its interest rate is usually the point when the market actually free falls into a bear market. So at least in the near term, what we see is even with the most recent FOMC meeting, the Fed is still kind of guiding the market for 2 more rate hikes this year, which would mean the Fed funds rate will be at 2.5% at the end of this year. And they are kind of guiding the market for 3 more rate hikes next year. So all in, as long as the Fed continues to stay on its rate hike trajectory, we do expect the S&P 500 index to kind of continue to move to the upside along with it as the Fed continues to signal out further vote of confidence to the market that it's still strong enough to kind of withstand further rate hike as the economy continues to grow. So all in, from the Fed funds rate perspective, we expect the general equity market to continue to rise along with it as the Fed continues to hike its interest rate. And the most interesting news, I think, will be the recent dollar strength that we saw. So the dollar strength has been kind of broad-based. So the blue line over here shows you the dollar index, which is a dollar based off a basket of currency. And then the black line over here is the US dollar denominated in offshore yuan. So all in, you can see since March, April, each period, we have seen the dollar complex itself kind of strengthening pretty firmly. So dollar index has been up 5% since April, as well as the dollar offshore yuan up 6%. So all in, the implication over here with the recent dollar strength we have seen is major weakness within the emerging markets. More so, we can see the EEM, which is the emerging market ETF, down 10% as a whole. And then individually, Shanghai Composite down 12%, Brazil equity market down 14%, and the worst of all, the Argentina equity market down 16%. So all in, obviously the dollar strength has been hurting a lot of this emerging market, but we do expect the recent strength in the dollar complex to kind of fade out. And on the technical front, we are seeing some sign of early weakness showing up within both the dollar index as well as the dollar CNH. So just to illustrate what the dollar index is showing right now, at least on a technical perspective, you can see over here since June, we have kind of tested a key critical resistance area at 95.15. Mainly this was formed back in October and November-ish of 2017 over this highlighted region over here. And as you can see, obviously the psychological round number of 95 right now is kind of causing some pain to the buyers. And it's kind of keeping a ceiling on the recent ascent. So all in, we have seen at least 2 bearish price action here, shooting star as well as a bearish engulfing bar here, kind of signaling to us that this 95 psychological round number is a key critical level that the market is watching. And looking deeper with the RSI, we are seeing a bearish divergence forming here, where the RSI is forming a series of lower highs shown by this diagonal downward trending line. While on the flip side of things, we see the dollar index actually making a series of higher highs shown by the diagonal uptrend line. So all in, with the most recent bearish rejection of this 95 resistance area, coupled together with the bearish divergence, we do expect the dollar index to right now kind of flip back into its downtrend and to hit back into its circular downtrend that was first started back in 2017. So all in, if the dollar index strength, at least that started back in March, if it reverses back to the downside, I think all in terms of emerging market wise, we do expect money to flow back into the emerging market side of things. And once we see money flooding back into the emerging market, as a whole sentiment perspective, we should see general risk-on sentiment flowing back into the global equity market. And same thing is true for the dollar CNH pair. So same thing, we are facing strong resistance at this level here at 6.69, or you can look at it as a psychological round number at 6.70. And all in, it is a resistance area that was formed back in September and October each period of 2017, shown by this highlighted region here. So last week we saw a major bearish reversal candlestick pattern forming around that level, all in signaling to us that the market is kind of holding that 6.69 level. And coupled that with the relative strength index study, you can see the recent strength in the dollar CNH pair has lifted the RSI into extreme overbought condition, recently at a high of 87. Anything above 70 in the RSI signals overbought condition, and 87 is extreme overbought kind of a condition. And all in, it tells us that we are expecting an imminent correction to happen at least in the near term for the dollar CNH pair. And couple that with the most recent bearish price action at the 6.69 resistance area, there's a high likelihood that we are going to see a reversal in the dollar CNH pair. So like I mentioned, as long as the dollar complex itself kind of reverses back into the downside, the downtrend, I think all in, it should be positive for the general equity market as well as the emerging market. So right now, I'll just dive into the individual components in the recession tracker, what they are showing, some negative things as well as some positive data. So first one I want to cover is the 2-10 spread, which basically measures the yield curve. And key thing over here is we are seeing further flattening trend within the 210 spread or the U curve. As you can see, in the last update, we kind of saw some sideways trending pattern in the 210 spread, where it traded between 54 basis point to 41 basis point. But with the most recent Fed funds rate hike that we saw in June, the 210 spread continues to invert to new 52-week low. Last week, we saw the 210 spread actually hitting a low of 29 basis point. So it's actually quite a dire straight in a way whereby we are pretty close to the 0% level, whereby once we dip below that 0% level, we head into inversion of the U curve, which is a pretty bearish signal on the economic front. So based off our base case scenario, we do expect another 4 to 5 months of further flattening within the 210 spread before that scenario plays out. And again, the general perspective here is that long-term 210 spread remains in this bearish flattening trend. So this is on the daily time frame chart on a zoom in view to show you on a more long-term view what the 210 spread is showing. So the 210 spread here, I'm showing on a monthly time frame chart stretching all the way back to 1983. So the 210 spread is shown at the top panel and the black line, and the bottom panel shows you the Fed funds rate. And just to illustrate the correlation here is as long as the Fed stays in its rate hike cycle, marked up by all these up arrows over here, you can see the corresponding move on the 210 spread is flattening, mainly due to the fact that by the short end of the U curve is more sensitive than the long end of the U curve. And theoretically, as long as the Fed continues to hike its interest rate, we will see further flattening within the 210 spread. And hence, you can see the most recent rate hike cycle that began in 2015 has resulted in the same kind of a flattening motion within the 210 spread. And just to highlight how we came out with the base case scenario of 4 to 5 months before the 210 spread falls into inversion, the yellow highlighted areas over here, back in 2018, 2017, as well as 2005, was during the period where we took the flattest period of flattening and kind of extrapolate how long it takes for the 210 spread to actually strips out of 30 basis point. All in on average, it takes around 4 to 5 months of flattening before the 210 spread kind of erases 30 basis point. So using the extrapolation based off the most recent flattening trend, right now we are trading around 30 basis point. All in, it suggests to us that it will require at least, if the trend of the flattening movement within the 210 spread remains, then it could easily take us another 4 to 5 months of further flattening before the 210 spread inverts, which means December 2018 this year is the earliest we could see a flattening of the U curve. But do take note, even when the U curve actually inverts, historically, the market doesn't fall into a recession immediately. So you can see the highlighted region over here, the red box, at all these 3 points over here in 1989, 1999, as well as in 2005. On average, it takes the market around 54 weeks before recession strikes. So in terms of that, in terms of timeline-wise, based off the 210 spread, it does still give ample time for investors to prepare for the start of the bear market. And like I mentioned again, it could still easily take us 4 to 5 more months of further flattening before we fall into the danger zone. And all in, we are still bullish on the equity market in the near term, as we are still kind of nowhere at the inversion part. So December is when it should get interesting. As of now, we remain pretty bullish on the equity market until we fall into the inversion side of things. Right now, I'll just highlight some of the more positive data point from the recession tracker. So here's the TED spread, which basically measures interbank risk. Rising TED spread shows rising interbank risk, and on the flip side, falling TED spread shows all is well, at least on the interbank perspective. And last month, we saw the TED spread continue to kind of fade off its 63 basis point high as well as 56 basis point high. And in the month of June, TED spread remained pretty subdued within a range of 43 basis point to 38 basis point. So all in, at least on the interbank level, there are no distress that is being signaled out to the market right now, which is why we are still pretty bullish on the equity market. And just to note, the key threshold to signal the start of a bearish market is at least a break above a 1% level, which is still a far cry from a current level of 38 basis point. VIX index is also showing relatively calm market. So despite the recent trade war scare that we saw at least 3 to 4 weeks ago, you can see there was some big green bars in the VIX index here. This bar is pretty huge, a move of more than 10% in a single day. But even with that particular spike in volatility, you can see the VIX index still trades pretty relatively calmly within its range. So 20 psychological round number seems to be the current range high, as well as the bottom part of things at around 11 as the range low. So at least in the near-term outlook, as long as the VIX index continues to trade within this gray range of 20 to 11, I think with that low volatility, it should continue to spur further movement to the upside for the general equity market in the US. Some economical data that kind of reaffirms the strong growth. So here's the retail sales number. So retail sales year-on-year data show at the bottom panel. You can see we are seeing further consecutive strong growth from the retail sales space. Has been growing pretty strongly for the past 4 months. Right now at a growth of 5.9% on an annual basis. And you can see there's a positive correlation between the S&P 500 index to the retail sales figure. So as long as we stay within the expansion phase above 1.6%, and if it continues to stay in the accelerating pace, we do expect the general equity market to continue to move to the upside along with it. And do take note that the key threshold that will signal to us the start of bearish market is if the retail sales number do actually fall below the 1.6% level mark, which is still a far cry away from the current 5.9%. Another good data point that was signaled out in the month of June was this Bloomberg Consumer Comfort Index, which basically tracks consumer sentiment. So we are seeing further optimism, kind of a resurfacing back into the market. So the last I did an update for the Consumer Comfort Index, we were seeing 4 consecutive weeks of fading optimism. But with the recent month of movement, we are seeing another 4 consecutive weeks of further growth within the consumer sentiment side of things. So all in, the fear that we saw last month was kind of erased this month itself. And as long as the Consumer Comfort Index continue to perform to the upside on an accelerating pace, you can see the general equity market usually tends to react pretty positively along with it. So as of now, consumer sentiment still remains pretty rosy, which is why we are still kind of a positive on the equity market, at least in the near term. On the manufacturing side of things, sentiment from purchasing managers are also pretty strong. So last month, we were highlighting some possible mean reversion happening within the ISM manufacturing PMI side of things, where we saw 2 consecutive months of disappointing data of its high of 60.8. And the reason why is because historically, ISM manufacturing PMI tends to follow this sine wave pattern whereby it will mean reverts whenever it hits an extreme high. So you can see the horizontal line over here at 58.1 seems to be the extreme high for the ISM manufacturing PMI, and whenever the PMI number tags that particular high point, mean reversion tends to happen. So it happened during somewhere in late 1990s, and then in 2004, as well as in 2010 and 2014. And obviously right now, since 2017, we have been reaching this high of 58.1 and definitely signaling that we are in a euphoria state. But the mean reversion scare was kind of erased with the 2 most recent data point, whereby we saw the ISM manufacturing PMI kind of reverting back to the upside. And right now at 60.2. So all in, as long as we stay pretty nicely above this range of 58.1, we believe in the near term, the equity market should continue to do fine along with it. And just do take note that for us to kind of get a bearish signal for the ISM manufacturing PMI number, it needs to actually close below the contractionary period for at least 2 consecutive months first before we can kind of be more affirmed that the bearish market has begun, which is still a far cry from the current level of 60.2. And another more interesting thing is the quarterly time frame study that we did on the S&P 500 index. So at the end of March, we gave an update that there might be some early crack signs within the quarterly time frame study for the S&P 500 index, mainly due to the fact whereby we are getting our first bearish quarter itself in Q1 of 2018 that disrupted a streak of bullish quarter, streak of 9 bullish quarter since the start of 2016. So historically, what we saw was that for the market to signal the end of the equity bull market and to form its record high, the market tends to form 2 consecutive quarters of bearish quarter itself before a bear market began. So you can see over here, this highlighted region here shows the dot-com high, whereby we saw 2 bearish quarter itself, kind of signaling the end of the bullish quarter, the bullish market since the whole 1990s decade. And once we get the signaling of the 2 consecutive bearish quarter, we saw the start of a 45% sell-off in the equity market. And the same thing happened during your GFC period, whereby we saw these 2 bearish quarter over here that kickstarted a 46% sell-off. So back in Q1 of 2018 this year, we first got this red bearish quarter, which was kind of a warning sign that probably the market might be forming its top that was formed back in January. But right now, with the benefit of hindsight, with Q2 in the rearview mirror, fortunately, Q2 came out to be a positive quarter. So Q2, we actually erased the loss in Q1 of 2018, and instead we kind of experienced a 2.93% 2.93% gain in Q2. So all in terms of the negative sentiment, we didn't get a second bearish quarter, which is a relief. And with this current bullish quarter, we expect the S&P 500 index to kind of continue its ascent and to search out for new record highs moving forward. And right now, we'll just dive straight into at least the near-term price action chart of the three main indices. So main highlight I want to point across here for the Dow Jones Industrial Average is this particular green line over here. So the green line shows you the 200-day moving average. And just to highlight how important the 200-day moving average is to the market, you can see this January sell-off, this 12% sell-off that we saw was firmly halted by this 200-day moving average, and subsequently the trade-inspired sell-off during the whole of March and April was again subsequently supported by the 200-day moving average. And then you can see the two most recent rebound of the 200-day moving average saw pretty strong rebound in terms of price action. We saw 6% recovery here, as well as an 8% recovery here back in May. So you can see even the most recent sell-off, again, caused by the trade tension, has been firmly supported by the 200-day moving average over here. And obviously, you can see market is placing a lot of emphasis on the 200-day moving average as a key supporting floor here. And ultimately, watching deeper and scrutinizing deeper, what we saw was there was some strong bullish price action forming around the 200-day moving average, specifically these 2 points over here. We saw hammer reversal candlestick patterns forming at the 200-day moving average. That by itself is pretty similar to the hammer that was formed here as well as here. So all in price action wise, we do expect the 200-day moving average to hold like the past 3 times here. And with the bullish price action, we do expect a reversal back into the uptrend to happen pretty soon for the Dow. And for the next target on the next leg up, we do expect the Dow to retest this June high of 25,400 points, and then subsequently to retest its January high of 26,684 points. Pretty similar picture showing up in the S&P 500 index. The weakness is not as bad as the one in Dow, since we are not really close to the 200-day moving average. But ultimately, at least in the near term, what we see is this higher low point here at 2,675 points needs to hold in order for this near-term uptrend to stay intact, which is currently holding up pretty strongly. And with last week's price action, we did get a pretty strong bullish break above the 20-day moving average. And all in with that recent bullish breakout, we are seeing kind of a bullish sentiment resurfacing back into the market. And hence, we do expect the S&P 500 index, at least in the near term, to retest this high back in March at 2,800 points. And once we reach that level, it shouldn't be hard for the S&P 500 index to retest its January high of 2,878 points. And last but not least, the Nasdaq, which is the strongest of all index, at least from a big boys context. You can see near-term wise, we need this level here, the higher low point at 6,830 points to hold in order for this recent immediate uptrend to hold, which is still pretty nicely holding up right now. And with last week's bullish price action, what we got was a bullish break above its immediate range high, as well as the 20-day moving average. It seems very likely that the Nasdaq 100 will kind of retest the 7,400 psychological round number next. And after we clear that level, the Nasdaq should continue to move in leaps and bounds of 100 points each, and the next one will be 7,500 points. And hence, all in price action wise, we are seeing pretty bullish price action, at least on the daily perspective, on all 3 major indices, which suggests to us that the risk-on behavior is definitely back in town. And all in summary, despite the escalating trade tension that we've seen coming out from US, China, and Europe, the economical data, at least from US, still remain pretty strongly intact and remain strong at the multi-year extremes. So until we see further deterioration from the economic-based data triggering their respective threshold, we will remain bullish on the general equity market out. And at least based off the 210 spread, the U curve, it could still easily take us 5 to 6 more months out before the U curve inverts. So in terms of timeline-wise, we are still expecting at least 5 to 6 more months of upside first in the general equity market before we see some minor crack sign. And like I mentioned again, the current bullish price action in S&P 500 and the Dow Jones, as well as the Nasdaq 100 index, suggests to us that we are definitely going to see a near-term rebound back into its uptrend. And for all 3 major indices to search out for new record highs in the meantime for the 5 to 6 more months out. So all in, we remain pretty bullish on the equity market for the US side of things based off our US recession tracker. And with that, we've come to the end of today's webinar. We'll pause right now for Q&A if there is any. Thank you. Hi everyone, Jeremy speaking here. There's a question asking in terms of the 210 spread after inverts, how much longer does a recession take to set in, assuming another 4 to 5 more months of upside? So again, referring back to that particular chart in terms of the recession timeline. So again, the vertical strips over here shows you the recessionary period. And on average, it takes around 54 weeks before the recession sets in. So based off the scenario whereby if we do take another 4 to 5 months of further flattening for the 210 spread to invert, it could still easily take the market another 54 more weeks before we see recession. And in terms of preparing for the market top for that, recession tend to happen slightly later than when the market sets its record high top. So on average, it takes around maybe 4 to 6 weeks after recession comes in, before recession comes in, whereby the market forms its market peak top. So all in, taking the 54 weeks as a reference point after the emergence of U curve for the recession to set in, probably erasing another 6 weeks off the 54 weeks average will give us around 45 to 48 weeks of further flattening within the emergence of U curve before we see a market top. So all in terms of timeline-wise, we are still expecting a lot of ample time in terms of preparing for the market top. And definitely right now is not the point where we think that the market is forming its top. And do note that usually at the end of the equity bull market is when we actually get the crazy move to the upside with lots of euphoria. So the last part is the part where we see extreme sentiment kicking in, whereby probably the market can easily rally for 4 to 5% within a very short time span. So we do expect that to play out for the last surge up within the equity market, but probably the top wouldn't be in so early for this year, probably somewhere later next year or even 2020 for that to play out. But watching the recession tracker should give us a pretty good guide in terms of when that might happen. So as of now, we don't expect it to happen this year, probably somewhere later next year or even 2020. And there is another question asking how about the STI index? Will it turn bullish too? So like I mentioned again, the most recent sell-off, at least in the emerging market side of things as well as Singapore, is mainly due to the dollar strength, the dollar index and the dollar CNH side of things. And with the expectations of the dollar index kind of turning down into a downtrend, as well as the dollar CNH turning down to its downtrend, all in, once that happens, I think we should see emerging market kind of gathering the fund flows again. And that should be a positive, at least in the near term. And all in, stacking that together with the recession tracker, we know that regional markets, Singapore, Hong Kong, do actually follow a lot of sentiment from the US side of things. So as long as the US continue to outperform to the upside, bringing the risk-on sentiment back, at least on a global perspective, we do expect the Singapore market, the STI, to kind of follow suit as well to the risk-on side of things and to kind of correlate to the US market. So hence, with the expectations of another 5 months of further upside within the equity market in the US, we do expect the Singapore market to track the US performance as well, at least in the near term.
Hi, there's a question on the lower selling prices we talked about for the property launches. Will it affect the debt level and the repayment ability of the developers? So I think for those under our coverage, like I mentioned, the heaviest exposure to local resi will be CDL. Their exposure to local resi over the total RNAV is about 30-odd%. But for CDL, in terms of the debt repayment, I think that is not a worry because their gearing as of now is very low. They have a strong balance sheet. In fact, I think they can withstand the holding of the selling prices. Like right now, I think if you look at CDL, their net debt to equity is about 10%. So I think that one is not a worry for them. For the next one that has the heaviest exposure probably would be Chip Eng Seng. That one will have about 20-odd% of total RNAV that's exposed to the local resi. I think the net gearing level for CES is about 50-odd%, but I think at least the mitigating factor will be that they will have cash flows coming in from firstly the Grandeur Park that is 90% sold. So as that project gets gradually built up, then the cash flows will start coming in as well. And also not to forget that the 300 over units sold, the down payment of 20% for those, as well as the hospitality segments that they have that will contribute recurring income. I think as a sector as a whole, the ones that are more exposed to local resi and more heavily indebted will be Oxley.
Hi, there is a question asking about our expectation on 2Q results of China Sunsin. So we knew that in the last and in the recent weeks, the Sunsin stock price dropped quite a bit. That was because several reasons. Firstly, because some investors may worry about the trade war between US and China, because some tariffs may be imposed on tires. However, Sunsin's exposure to US market is only 5%, and they takes up about 21% of the global market share. And also, according to the management, the newly added capacity of 10,000 tons of accelerators and insoluble solvers will be postponed. That means as of June, they haven't received any approval from the local government. That means it will be longer than expected for this new capacity to commence operations. So when it comes to our forecast about the results, I can update you about the ASP of the product mix. So in recent months, as of June, the market rate of accelerators was about 21,000 RMB per ton, while the antioxidant was about 20,000 per ton. So in the first half of this year, these two products ASPs were above 20,000 per ton. So that means in the first half of this year, the prices of these two products actually were quite stable. However, the major raw material aniline price dropped significantly in this 1 month. The aniline price right now, as of last week, was selling at below 8,000 RMB per ton. So compared to January this year, it dropped more than 30%. So we expect that the second Q results at least will be comparable to first Q results, and we do expect it is possible to outperform first Q as well. Thanks.
Hi, if there are no more questions, then we'll call an end to this week's webinar. Thanks for tuning in, and we hope to see you guys again next week. Thank you.